Welcome to ForexTV.com. Today's Friday, May 8th. I'm Tim Kelly with your New York Forex Market Buzz. Euro strengthened against its lower yielding counterparts today in New York as some encouraging economic data fueled risk appetite. The single currency added to multi-week highs against the dollar and yen and also rebounded against the pound. U.S. dollar is weaker across the board as U.S. equity markets are surging to close the week. Crude oil prices continue to climb and gold is weaker at midday. Now for a quick look at the headlines. Well, a report released by the Labor Department on Friday, that's today, showed a continued decrease in employment in the month of April. The report showed that the economy lost far fewer jobs than economists had been anticipating. The report showed that non-farm payroll employment fell by 539,000 jobs in April, following a revised decrease of 699,000 jobs in March. The decrease in employment marked the smallest drop in jobs since October 2008. Economists had expected a decrease of about 600,000 jobs compared to the decrease of 663,000 originally reported for the previous month. However, with the continued decrease in jobs, the total number of jobs lost since the recession began in December 2007 rose to 5.7 million. The Labor Department also said unemployment rate rose to 8.9% in April from 8.5% in March. The increase, which lifted the unemployment rate to a new 25-year high, came in line with economist estimates. Canadian employment grew by 36,000 in April, the result of an increase in self-employment, that according to data released Friday morning by Stats Canada. Despite this increase, overall employment has fallen by 321,000 since the peak in October 2008. The unemployment rate was unchanged at 8% in April, remaining at its highest level in 7 years. Indicating easing inflationary pressures in the British economy, output price inflation in April reached its lowest level in 5 years. That according to the Office for National Statistics. On Friday, that UK's output price inflation slowed to 1.2% in April, marking the lowest rate since April 2004. Economists had expected factory gate inflation to ease 0.7% from March's 2%. In Germany, Germany's industrial output was better than expected in March, raising hopes of a recovery in the economy, that according to a ministry report released earlier today. Data released by Germany's Federal Ministry of Economics and Technology revealed that the industrial output remained flat month on month in March, following a revised 3.4% fall in February. Industrial output also fared better than economists' expectations of a 1.3% decline in March. Today we're joined by John Netto, Chief Investment Strategist at NetBlack Capital. John, welcome to the program.
Hey Tim, thanks for having me.
Hey John, you've been jumping around the globe here, certainly jumping around the United States, and I appreciate you taking some time out to join us. You know, we see a return to risk appetite here in a pretty big way the end of the week here, hitting new highs in equities for not seen in a long time. Dollar has seen some distress here on Friday. You and I talked a little bit about equity correlations. I want to begin there, and maybe I'll throw it over to you and talk to me about the equity correlations as you were indicating in Europe, because you got an interesting story there, and the U.S. and how they relate to this risk appetite.
Sure. Like all trades, you want to understand the chronology or the history behind what preceded or what hopefully which will provide insight for subsequent moves as well. We look back to last October, the dollar became the safe haven currency around the world. As a result of that, there's always when you're going to invest in other countries, okay, the currency risk that you take on from foreign international equity markets is clearly a component that someone has to contend with if you want to own the FTSE, which is England's stock market index. If you want to own the DAX or the Dow Jones Eurostoxx 50, depending, or you want to own the Nikkei or the Kospi in Korea. So one of the risks you take on is obviously how will the currency either appreciate or depreciate? Well, last October, the dollar being as strong as it was, November the dollar being as strong as it was, it actually helped the S&P outperform a number of the major global indexes out there, especially from the more risk appetite countries like Latin America, Korea, some of the Eastern European indexes out there, even Russia as well. So being aware of that and looking at the indexes out there can help serve a lot of benefit to currency traders who want to understand the closer dimension between risk appetite and risk aversion.
Okay, John, sorry, I was just doing a little data check here. So when we're looking at the correlations here, we see S&P right now just surging here. Again, just doing a quick data check. We're past some key levels here. The Dow's up 126 today at above 85. The S&P at 924, up 17. When we see the equities rising this precipitously, very much unexpected, according to the analysts that I spoke with. Last week, had a lot of analysts saying that the S&P was going to fall. Should we be looking at something else besides S&P here in your estimation?
I think if you take the mindset, that's a great question. And if you take the mindset that equities are going to rally, I would, the relative outperformance of the German DAX or the Eurostoxx 50 against the S&P for this move really replicates international portfolio managers to take on equities, but equities where they can also see appreciation in the currency as well. So if your perspective is that the worst is behind us, then a number of the dynamics which cause the sell down, i.e., credit liquidity or a slowdown in the global economic package, you're going to get better. You probably will get better bang for your buck by being maybe long Europe, by being maybe long Latin America, by maybe being long Brazil or long Russia, as opposed to being long the S&P. And so, if you have the means to look elsewhere, you could trade options. The Eurex futures are one way to gain that international exposure. You can trade the Dow Jones Eurostoxx 50, which trades in ticks of euros. Actually, you can trade the DAX 30, which trades in 25 euro ticks, or they actually trade in half ticks. But it lets you sort of get a better bang for your buck, because as traders, we all want to get into positions that allow us to deliver the best risk-adjusted return. And so I'm going to take on equity exposure because I think risk appetite's back at play. I want to take on that exposure in a market that I think will outperform.
Okay, so if I'm trading currencies, so, are you suggesting that I should be watching DAX as much as S&P?
Right. I think the DAX S&P relationship serves as a great proxy for how that appetite's unfolding. And we would talk about the outperformance. We've seen the euro go from 127, 128 up to 135 now. That's clearly helped contribute to the outperformance of the German market, because when you regress the performance back in terms of USD, how the currency factors into that is a very real part of that outperformance or underperformance, as was the case last year.
Okay. Hey, John, let's get to specific performance right now, and let's talk a little bit about the current environment. We're seeing some highs in the risk currencies. We've got Canada gaining precipitously against the dollar, Aussie gaining, Aussie now pushing 76, 75, and we haven't seen those highs in a long time. Also have euro gaining, making new monthly highs here against the dollar. Do you think we can sustain this here? Talking about value, and again, you and I talked before the segment saying, hey, okay, what's the best value in the country? Because trading currencies is country against country. Do you think we have the right valuations here, or are we going over? Are we overshooting here in risk?
Well, being in terms of the project that I've just done, and that is generating alpha, finding better risk-adjusted returns, and doing with a number of the top firms in Chicago that do this stuff for a living in a major capacity with a lot of velocity behind them. I think the real question is, what currency crosses offer the best value, and maybe how can I structure these trades so that I can really dampen a lot of my volatility? So I think a way, if you want to play this equity rally, if you think the equity rally is going to continue, I'd look at being long Aussie JPY and maybe regress out by being short the S&P. And so by being long Aussie JPY, I have a chance to earn a little bit of a carry there. It's very strong technically. And if you think the global rebound is happening, it would seem that the commodity currencies would benefit from that regard, hence helping Aussie JPY. Conversely, if we do begin to come back a little bit, because of the strength of some of those metrics I just talked about, like even if we go sideways, like a sideways market would help that cross better than maybe the S&P selling down. So I think if you can come up with creative and imaginative ways to structure some of your exposure, you can do a lot to dampen volatility, but still give yourself a nice residual return as a result of that.
Okay. Hey, John, let's talk a little bit of as we close this segment up on a Friday. I know you're down in Las Vegas right now and looking to relax a little bit today, which is perfectly understandable. Tell us a little bit. Let's talk a little bit of sentiment here. What's your thought? Excuse me. What's your thought on the current state of the equity markets? We got a little bit more than green shoots at this point. I think we can agree. Do you see this rally continuing?
what I see continuing is a market that will continue to frustrate traders for the short term. But the very perverse way that this rally has happened, it will probably run up to the 945, 950 spot, and then when we do get a real pullback, I think it's going to run over everyone. And because as a professional trader, what a lot of pros do, what a lot of seasoned people try and do, is wait for pullbacks in underlying markets. And the one conspicuous thing that's been not part of this rally is a definable pullback so far. Since the lows we put in near the end of February, we have more or less gone straight up, sideways. And a market that behaves in this type of binary manner, or when I say binary, I mean straight up or straight down, typically tends to generate that same kind of momentum during the pullbacks as well. And so most people who actually ironically patiently waited for good spots will probably get hurt. So I think that we could ride to 950, 955, but when we do turn around, it's not going to be a gentle pullback that we get where you could come in and buy the dip or buy a nice pullback and it will continue its uptrend. It's probably going to pull back very, very sharply, and then from there you have to sort of figure out how you want to handle that, which is why, again, talk about structure and talk about dampening volatility to build a better risk-adjusted return.
Okay, so in the end result, it's the correction is out there, but we just don't know when.
This market is so fluid from a day-to-day basis. I'm long and short the S&P anywhere from 50 to 100 times a day, okay? So for me, I have a longer-term perspective that I manage my overall options exposure with. I have a shorter-term perspective that I am looking to maneuver stuff around with, what currencies I trade. And again, like my portfolio and how I trade and manage risk in NetBlack Capital doesn't resemble a typical mutual fund. There's a lot of variables to it. There's a lot of components to it. There's factors like volatility, my Vega risk. There's factors, my currency risk, how do I want to mitigate those, what my daily, my value at risk is overall. So there's a lot of things I look at. Okay,
hey John, we're going to leave it there for right now. Thanks for joining us today.
Thanks a lot, Tim. Anytime.
This has been your New York Forex Market Buzz with John Netto of NetBlack Capital. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on ForexTV.com.